a lot of this money, like, because
whoa, that's a lot.
man,
4,000 to
yeah,
5 million?
from K, I did it when I remember with Adam. I bought the OMI for 1,000 euro, and I get it out after 3 weeks, like fucking 150,000. Then Pirate Chain and many others,
I
like, you know.
remember,
But then
he was the one that called secret first.
yeah, man.
Stuff,
You research hardcore.
I did in November and December. I did the research. I took the Sky. How was the name? Sky Network Secret. I get the OMI, and yeah, we were promoting that, like, you know, and they were bang before the Bitcoin went 45. But then, like, May completely crashed it. But then I moved from Ireland and I start traveling 1 year. I living just for I just take the profits and fuck all, you know, because I lost the job as like a chef just for that not wearing the mask properly. So I decided that fuck all. But what I see now that the thing is, the lesson that people didn't take it out from all the crypto, that was my believing that it will survive, and that was my believing that crypto is here for this reason. We need the fucking freedom, and still people are not wake up with that, you know. So easybility, you can buy the fucking 1,000 tokens tomorrow. They can be worth fucking nothing. Look at the Luna, like, you know. I'm glad that, for example, I didn't took the profits, because I've got a plan to take out the profits, and because I hate fucking Ethereum. I've got an allergy for Ethereum. I don't know why. I just got an allergy, and my plan was go full on UST. And exactly that time when I was in when the Luna bullshits happened, I was in the fucking off-grid, living in the mountains with my dog. And look, I could put all my fucking profits in the fucking UST. Next day, I could be fucking zero, like, you know. So you never can be smarter than fucking market, like, you know. It's not possible, like, you know. We just have to keep steady. We just have to protect the fucking privacy. That's for sure, because they can't stop us, you know. They can't. It's not possible.
We want to be
we need, we need usability, and we need we need this kind of like Monero, Conkill, like we need the pirate chain, but people don't fucking care about that. That's the problem, the main reason. People like buying the fucking Shibo, like what you can do, like, you know, you can stock up with your stuff and be ready for the next bull run, because if they hit the shit hit the fan with like supply chain, with the no money, they will start thinking, because people have to feel the fucking pain to start thinking, you know.
Smokey, what do you think of Polkadot?
I don't care about the Polkadot, you know. For 2 years, like, it's for me, it's shown nothing. It's like fucking Cardano. Maybe some in the future. Fuck it, like, you know. Man, for everything I use Monero. I don't care, like, you know. I use Monero. I use the smart way, in the way that I use the VPNs. I use the no ID emails. Like, the way I cash it out in Poland is completely anonymous. You know, they can't fucking track me. Whatever they will do, I make the hard lesson for them, like, you know.
What price did you get in at Monero?
What?
What price did you get in at Monero? Because you get in really early.
No, not early. Like, I was when the pandemic, when the scandemic starts, everything, the Monero was like fucking $30 or $40. That time, I met the Jeff and Dollar Vigilante. I was listening to Jeff. I was listening to Max Egan. Then I changed everything from my system. Like, I leave the Windows. Even I was doing the music on the Ableton, but I fuck everything was connected was with Apple, Google. It took me half year to get rid of all these systems, yeah. But then when they do the announcement with Pirate Chain, I invest some money in the Pirate Chain. But then the thing was that Monero at that time was like fucking 80, 70 euro. But you see, on the way I was buying, when I get the profits from OMI, like I said, like I invest 1,000 in OMI in January, I get out with 150 after 3 weeks, like, you know. And what happened then? I buy a lot of Pirate, I buy a lot of Monero. So price was different, like from 140, from 100. I even was buying the Monero for 500, you know. But I use the Monero all the time, every day.
Good for you. Good for you. Is that your favorite?
I don't look at what?
Is that your? I mean, do you have the most faith in that from a long-term perspective? This is the next Bitcoin.
I believe in that. I don't know that Monero is the solution because there was a lot of issues and everything. I love, for example, Clonkill, yeah, you know. For me, it's the pure Conkill network. I see the CryptoNode protocol, and in the way that is transparent, in the way that is auditable, I see the fairness of the emission and everything. This project I love. I think is the best, you know. But it's all about the adoption, like, you know. The way that I love Monero, like Cake Wallet is doing the nice thing with the gift cards in United States now. But when I use the Monerujo, I've got everything, man, everything. I can top up my cards, new, fresh Bitcoin on the blockchain. They can track it anyhow by side shift IO, whatever. Like, you know, you've got a Monerujo, you've got a Monero, you're free to go. You go to the ATM machine, you scan the fucking code, you take the fucking money. Like, anyway, I didn't use the way in a proper way in Poland. I didn't use the time because till November in Poland, every day. Daily limit was 15,000 euro, no QIC, guys. 15,000 euro, no QIC, cash in hand. You can imagine that, like, you know.
Yeah.
like it's a madness, like, you know. But the way what I love in the Monero is the usability, man. You just buy on the trade-off, you send it 20 minutes, you're ready to go. I can go. Like, for example, in Poland, I living in the way now. I found the guy who's in Poland. We've got a kind of system on the ATM machines, which we call it Blick. Okay, so when I send the when I use the Monerujo and send the BTC to the guy using my Monero, so he can track it back, whatever they can't. But when I sent him the BTC and he received the BTC, he called me back and he gave me the ATM code, which is expired after 90 seconds. Okay, and I cash out from any ATM in Poland, like, you know, for maximum 1,000 euro per day at the moment, like, you know. So I just send the Monero, I go to ATM machine, he send me the Blick number, I cash out, like, man, life is beautiful like them, you know. Fuck them all.
That's the only thing for me is I haven't learned how to cash out on my side, being from over here in the Bahamas. We do have we do have FTX over here that just opened up, but I don't know if I want to take my chance like KY and see with FTX and having to transfer the funds from them over to my bank and all that stuff. I don't know if I want to go that route, but I need to find a route to be able to cash out when I need to or when I want to.
Yeah. You see, I think that's the thing, you know. That's the thing. I don't know how long time left, you know. I know that crypto don't go anywhere, but they can make it harder for us. If we can't cash out to the real money, only one thing can save us, it's adoption. That's it. It's all about the adoption. If the people, like, I bought my super van. I will send you the picture. I'll get my Volkswagen van, multi-van. I bought it for Monero, like, you know, no questions, no nothing, you know.
Did you get into Pirate Coin really early too?
Yeah. I was getting like when Jeff announced it. After the pump and before the pump, I bought it.
11 cents.
Yeah, something like this. It was after the small pump because I was late. Of course, nobody was early. That time after their after their announcement, I was that time, you know. Wow. And but I was betting about the Arkuma that time. Arkma. So I bought Arkuma that time. But the best thing which I did when I get the profits from OMI, I invest in the pirate when it was like fucking 20 cents or something. It was in February I bought it.
Wow.
And I bought few thousands, and then I got like 25,000 of pirates. I bought it that time.
Pirate King.
Yeah. I yeah, I spent like fucking 4 or 5,000 on pirate chain, and half pirate chain and half Monero. And then the pirate chain went from to fucking $16. And of course, what I didn't fucking sell it. I didn't fucking sell it, because I was believing that that's
In
the
community, right?
just beginning.
Yeah.
That was just beginning.
I'm gonna invest in this for the long term. I want the community to help. I'm gonna help out the Polkadot network. I'm not gonna unstake it. Fuck everybody. It's like, no, I should have, because I'm feeling a lot of burn right now. This is bad.
Yeah.
But
Yeah,
anyway,
funny times. Funny times, yeah.
well, hey, we got to have you on, Smokey, man. You've been like, you can go to coins early. I don't know. Do you have a dev background? Computer programming?
No, man. I'm in crypto from the pirate chain announcement.
Okay,
Just because that time I get the money to invest a little bit. Just put 1,000 on the beginning, and for the subscription of Doral Vigilante. But before, you see, for me is that most important thing that I was not in the crypto like, wow. Of course, when I earn the fucking crazy money, of course I get on the like God mode, God mode, like fuck it, never fucking finish. I'm under retired anymore. But I'm the honest guy, like I'm not nice guy, and I didn't bought the fucking Lamborghini. I get my nice van. I sorted out my family. I know it's just crypto. It's just money. Like it's fucking nothing. Like it's all about the love. Like But yeah, I got a good mode. I've got a good mode. You can get, of course, you can get it if you fucking invest 4,000 euro and after 3 months you've got a fucking $500,000. Like of course you got it. Like then there is no borders. Like there is no borders. Like but you see, it's all about the lessons. Like and I try to catch my lessons every day in the way that don't get the sentimental way to the emotional way to the coins, whatever it is a Bitcoin or not Bitcoin, fucking sell it when you've got a profit and wait for your time. That's it.
Sean, you want
That's it, like
So thanks. We got I appreciate your enthusiasm and getting in early. Sometimes the early bird gets the worm, and that's half the battle. What would you say to guys that kind of got into crypto a little later? Like, I'm a trader from an ES background, and I kind of just switched over in 2019 is when I started taking it seriously. So, I think I started trading Bitcoin in 2017, but not really investing in these altcoins. So I opened this channel. What would you say to people that went in big and are just holding right now? Would you say just hold on to it and just keep staking, and a lot of these will recover, assuming you're in a top 20 decent coin? You know what I mean? Smokey? Oh, maybe he's muted.
Okay, guys. Sorry, guys. I switch off for a second. I have to organize the ticket in my fucking train. So I will back in a second.
Yeah, you know what? We could maybe we could start with Nam here because she's our guest speaker today. But we got to have you on too. Maybe we'll talk.
Oh yeah, exactly.
Yeah, Nam. So I mean, Monero.
Yeah,
hyped right there.
We talk after. Yeah.
Yeah, for sure.
We talk after, right? Yeah, man. Boom.
All right, Nam. Well, floor is yours.
Okay, thanks, Matt. And yeah, hi everybody. I'm Nam. I'm on the other side of the world. It's 11 p.m. my time here in Dubai. Yeah. I'm excited to, share what I presented at Monerotopia earlier in April. I don't know if any of you saw the video that Monerotopia, the channel, they put it out a few weeks after the actual talk because the slides weren't that clear in the conference, and there was some detailed graphs and tables on my presentation that weren't showing clearly on the day of the presentation, on the day of the conference. So they took a while to edit, and finally we got a good video out that summarizes the talk. But I'm happy to do the talk again, as well as throw in some updates, because obviously the world and the economy and the whole macro sort of scenario has changed since April, and it changes every day. So I think we're officially now in the recession territory, and soon we're going to start seeing some painful um, some painful stuff happening, like layoffs and stuff like that, like just not good stuff. So I think we're heading there. Most of my presentation was sort of outlining why we're, about to enter rough times, and we're like everything that's going on globally that kind of tells us that we're in like what do you call it, like choppy seas, or basically like we're in uncharted territory economically speaking, because there's been all this unprecedented money printing. So with the whole COVID thing that started in 2020. So yeah, let's just dive right in, I guess. I'm gonna do the full screen so you can. I don't know if you guys can see it.
Pretty clear on my end.
Yeah, I can see it on my end also.
Okay. Yeah, so I'm just making it big. So yeah, 5 sort of broad, subjects or topics that we talk about. Obviously, the presentation is a lot about Monero, and it was presented in a Monero conference. But like the first part is pretty general, macro stuff. So when I presented this, we were sort of, I guess in March sometime, we started the whole, we saw the whole Russia-Ukraine thing start, and it's still going on. And, they're making some pretty scary predictions now. But at that time, what we saw was supply restrictions. So basically, geopolitical and global macroeconomic forces are all dependent on supply and demand. Higher the supply, the prices fall. Higher the demand, the prices rise, and vice versa. So lower supply, prices rise, and lower demand, prices fall. So yeah, supply demand, that famous chart that the one where you see the supply line and the demand line that cross each other, and that's where the price is defined by free markets. But obviously we're not in free markets. We're in highly manipulated markets. And so what we're seeing globally right now is every country's been printing money since the start of 2020. The US has probably printed in quantity the most number of dollars, but percentage-wise, there are actually countries that are printing, or regions, I guess you could say Europe, and ECB is a central bank that's printing even more. Japan's been printing even more. So you see like this race to the bottom where currency is getting devalued, and like every country is running that race. So in other words, the same amount of goods and services in a domestic economy or in a global economy are being met with pretty much an unlimited supply of currency. So obviously, when you have the same amount of goods and services that are being chased by a lot of paper currency, a lot more paper currency than ever existed before, then you start seeing price rises. That's obvious. And then add to that supply restrictions. So as you can see in this chart specifically, Russia is like a powerhouse of commodities, oil and gas commodities, and also precious metals. You can see gold and platinum, coal. It has agricultural commodities. So literally, like, Russia is one of those countries that just when you think of net exports, or you think of this term called the net. So the net exports of a country are how much more does it export versus what it imports. So Russia is one of those countries that has a humongous export surplus. Export surplus meaning it just sells to the rest of the world, and it doesn't need a lot of imports from the rest of the world. I guess technology, maybe a few other things, but like commodities wise, this is really a heavy commodity focused export nation. So you can see all of these petrochemical, the whole hydrocarbon industry. Then you see refined products, coal, gold. Actually, Russia is one of the largest exporters, the top 5 exporters of gold. Natural gas, it supplies pretty much all of the European countries their gas, especially in the wintertime. It becomes really important that the pipelines are flowing correctly. So yeah, so what we're seeing is on a global sort of stage, we're seeing money printing by every country literally, and then we're also seeing supply restrictions, because then what happened over the last 3-4 months is Russia started getting hit with sanctions, and it sells so much. I mean, it really sells so much commodities to the rest of the world that it sent all these commodity prices soaring. So this next chart just shows us how crude oil is starting to go up into the 3-digit territory, from like even high 20s at the start of 2020. In fact, at the start of 2020, it went negative, negative $37, if I remember correctly. I was still working in those days, and I used to work in oil and gas, so everybody started freaking out. There were layoffs the next day, but anyway, so from a really low, like 2-digit price, we're now comfortably in the hundreds. I'm not sure what the price is like right now as of this today, but yeah, it's pretty high. It's up there. I mean, I guess all of us filling our tanks every day at the gas stations notice it. So then you have all of the petro-derived products, so the products that come out of so crude oil goes into the refinery, and you have things like naphtha, jet fuel, kerosene, diesel. So you have like all of these products that come out, and obviously all of those as well are shooting up, like they're going up in price. So yeah, don't want to go into the details, but like the refinery uses as fuel natural gas or other things to heat up, all of these boilers and things like that. So again, since natural gas, again, the fuel that the refinery would use is also going up, then literally the processing costs have also gone up. Russia and Ukraine are also amongst the largest global agricultural exporters. So this chart shows us how you see these 5 countries, Russia, US, Canada, France, and Ukraine, are in the top 5 exporters of wheat. And wheat is a pretty important agricultural crop. And then on the next chart, you see all of these kind of less developed countries that, and if you go like towards the bottom of this chart, you can see, do you see my mouse pointer, by the way, or no?
Yep.
Yeah.
Okay, cool.
Yeah.
That's good. That's good. You can see the pointer. So if you see these lower countries, you can see that some of them are actually 100% dependent for wheat from Russia and Ukraine. Just these two supply literally almost all of their wheat. So wheat is really important, especially in the poor countries. That's how bread is made, right? So yeah, you see the wheat prices spiking, and anhydrous ammonia and natural gas. So these are the two. You can see the ammonia is this one, and this is natural gas. Again, gas is $6, which it used to be $2.5. I remember a few years ago, and ammonia is literally at 1,000. And I remember back in the day when I was really deep into fertilizers, we're looking at $350 ammonia per ton. So it's crazy expensive right now. So obviously agricultural inputs becoming expensive make agricultural products expensive. So another trend that we see coming out of this Russia-Ukraine situation is the de-dollarization trend. So maybe I can hear somebody's static noise over there. So if someone's got their mic.
Yeah, it's fellow Gister. I just turned off his camera and his mic. I don't know who it is.
Oh, cool. Thanks. Yeah, I couldn't hear myself. So we have this de-dollarization trend going on now, where everyone's saying, we really need this cheap oil now that Russia's selling cheap oil. Like I know India is doing it. They're like, oh, well, you know what? Forget it. We're a poor country. We're gonna import Russian oil, because we need it. And if we're getting it cheaper because nobody else is buying it, then that's fine. So yeah, anyway, so they worked out an arrangement where they do a rupee ruble exchange, and they're settling it that way. So a lot of these, basically all commodities sell in US dollars, right? That's why dollars are so important in the world. It's a reserve currency. There's just a huge demand for it always, because every country has to, everyone needs energy. So you go onto the global market, and countries that don't have oil need to buy some, and countries that do have it need to sell it. And so they used to do that. And well, they used to, and they still do, and sell it in dollars. But now they're kind of starting to go around that system. And we're seeing, so you can see like, the Russians told the Europeans that if you want the gas, you're going to have to buy that in rubles, like pay us in rubles with immediate effect. This was March. So stuff like that. And then there's Visa and MasterCard, like they're pretty big for payments around the world, and they stopped their operations in Russia. And so China's UnionPay is now taking over. And obviously Visa and MasterCard are like, they're obviously a lot of their payments are dollar based or euro based. I mean, it can be in any fiat, but because they are American companies, you would see like a movement away from their networks. So you're going towards the China UnionPay network, which is, I guess, yuan based. But yeah. So I guess a thought coming out of all of this is, yes, we're going towards de-dollarization, and we're like going to probably see the dollar getting less importance over time. But what kind of role could crypto have in this scenario globally, right? And there should be some, because I know after this presentation, or just like last week, I think I saw a headline saying something like Russia is going to consider selling blockchain, or it's going to consider pricing some of its exports, its commodity exports, in blockchain terms, so in cryptocurrencies. So I don't know which one. Obviously, I would say Bitcoin would be one, but yeah, I think they would, maybe make it more than that, more than one. But let's see. So towards the end of this presentation, we start going into issues with Bitcoin. I think most people here would be familiar with that. But yeah, next sort of macroeconomic situation that we have to talk about is the whole pandemic. And obviously the pandemic isn't over. They've come up with new mask mandates here where I live, and they put really high fines if you're caught without a mask in public places. So anyway, it's becoming really annoying, but we're clearly not out of this pandemic. So I guess I shouldn't say post-pandemic, but anyway. So the pandemic consequences. So starting March 2020, you started seeing incredible amounts of money printing. So unprecedented money printing has created one, asset bubbles affecting global equity, real estate, and bonds. So just to recap, we had a huge crash right at the time I graduated from college in 2002. That was a dot-com crash. And that was very, very focused around equity prices, so stock prices. Then the next big crash was 2008, and that was focused around real estate prices, so everybody called it the housing crash. But at the time of the housing crash, you also had pretty heavily overvalued equity. So stock prices were also pretty exorbitant at that time. But now what we have is, they're calling it the everything bubble, and there's a good reason for that, because it's not just equity that's extremely overvalued, it's real estate and it's also bonds. So I'll go into each one, but the bonds is the new one. So I'll spend a little more time on that. Then we go into the inverted yield curve, which basically is like a leading indicator of a recession. I'll go into that. Global cost of living crisis, again due to inflation, and the unsustainable sovereign debt levels. So let's go into each one. So the everything bubble. Just quickly, what is M1? It's cash and savings accounts and checking accounts. And M2 is M1 plus, a few other accounts. It's money market funds, certificates of deposit, and time deposits. So they started printing the M1 like crazy. So this yellow line here, and the M2, which is actually the real sort of representation of how much money there is in the system overall. They're both at unprecedented levels now. We're saying it's, they actually stopped reporting this on the Fed's website. So this is the last information we have, but it's probably gone beyond this number even by now. I wouldn't be surprised. But yeah, it's around 23 trillion of M2. And it's been, it's not even that long ago. We were all around even at this time. And see, the M1 was at pretty reasonable levels, I guess. Even though, look, so we live in a debt-based monetary system. That means you have to keep the system going. You have to keep printing money to repay that debt that you've created by, creating that new cash in the system. So every time someone goes to the bank and gets a loan, that's creation of money. The bank creates the money. So there is no way that the inflation can be reversed. Like you would never ever have a situation where they won't print money. It's just always going to be, it's a de facto, it's built into the system. Yeah, so, sorry. I wanted to talk about bonds, but I guess, okay, I'll come back to the bonds. So stock price bubble. Now, this is a composite market value to GDP. GDP is a gross domestic product of a country. This is the US. And we see all of the stock markets in the US. So like the NASDAQ, the New York Stock Exchange, and like lots of the other stock exchanges, maybe the smaller ones, combine all of their market value and you plot that against the GDP of the country. And you see that the market is over 2x GDP. So you ask yourself the very obvious question: how do market valuations go past like the gross domestic product of a country? Like it makes no sense to a logical mind. So, and we're seeing that number. So we're seeing 216% market value to GDP, and we hit that last November. So over 6 months ago. The long-term trend line. So you see this black line. So we've usually been sort of in the 50%. So this is 50, this is 100%. So even if you say like the GDP is the valuation of the stock markets, the composite valuation of the stock markets, you're still kind of being reasonable because you're saying, okay, the entire stock market of the US is basically the GDP. So there's no private industry. Let's just cancel out all the mom and pop shops. All of the companies that are publicly listed are basically what the GDP is. But here we're saying that the GDP is twice that, the value of the valuations of all of the stock markets, which is crazy because you haven't. Yeah, I was like, it's kind of crazy. I'm sorry, the other way around. The stock market valuations are double that of the GDP. That's why it's crazy.
That is crazy.
Any questions?
So
Yeah,
basically it's saying, hey, how could all these companies be worth more than what they produce? They're super overvalued and it's a casino. Is that really what this is showing us?
Yeah, that's exactly what it's showing us. It's saying that the prices at which these companies are trading is nuts. It's nuts because the gross domestic product of the country is this. And we're saying that the prices of these companies is 2x that. So, I mean, it doesn't make sense for any country, right? So
It is crazy.
It is pretty crazy. So yeah, let's just, so also to show you how crazy it is, back in the day when I was sort of entering finance, I would see a price to earnings of 14, 15, or like high teens. And I would just be like, whoa. Like anything that was like an 18 or a 19 would be like, hell no kind of thing. But look at this, like just look at this actually. Independent power and renewable producers. I mean, and this is crazy. So this is crazy. Especially if, you've seen the multiples that, we used to have back in like early 2000s or whatever. Now, this is a completely new measure, enterprise value to revenues. So just to summarize, this is enterprise value to revenues. Enterprise value is the value of the equity plus the debt less cash. So that's basically the entire value of the company. Enterprise value to revenue, enterprise value to EBITDA. EBITDA is an indicator of earnings after, before interest, depreciation, and all of that stuff. It's just something that you use as a proxy to net income, except it accounts for all of the depreciation and tax and the tax. Price to earnings is how many times earnings. So how many times net income is the price of that company, and price to book. This is a pretty stable number. So yeah. So anyway, so what I'm trying to say is enterprise value to revenue. That first multiple over here, that used to not even almost, like, I don't even remember seeing this before the last 3 to 4 years ago or 5 years ago. Like, this is something so new that they started reporting valuations in terms of revenue. And the reason they've started doing that, especially for a lot of the tech companies, is because these companies make like EBITDA is a number that hopefully if that number is positive, that the company's got some cash flows coming in. But a lot of these companies are, especially the tech companies, and I've looked at some valuations, they're like, oh, we're going by, so let's say now it's 2022. They're saying we're going by our 2024, revenues, and we're going to value ourselves at, 5x or 10x our 2024 revenues. Now, bear in mind that these companies have higher cost of goods sold. They've got probably gross loss. They don't even come to a positive EBITDA. So they're EBITDA negative. They're obviously net income, like they're net loss making. They're EBITDA negative, and they probably, some of them even have like gross loss, not a gross profit. So that's the reason they have to fall back on like literally the top line of the income statement, which is the revenue, which is kind of crazy. So that's why they say, oh, we're valuing ourselves so much revenue times X.
I have a quick question. How are they allowed to value their future cash flows in 2024? Like, how are they allowed to put that multiple on something that's not real? How are they? I don't understand.
Because that's like selling hot air, right? That's literally all transactions happen at, oh, this is our business plan. We're going to achieve all these sales. We're going to do this. We're expanding in these markets. And they build up like a 500-page document saying, this is exactly how the future is going to look. It usually looks nothing like it, but they actually do transactions on those bases. So, and that's how these companies are trading so many times their earnings, like look like all of this and all of this. That's how they trade at these multiples on the stock exchange. And when you're buying a stock of like, Apple or any of these tech companies, a really, really hyped up number that is probably valued at so many times their 2025 sales, or I'm exaggerating a little bit, but yeah, they're like, oh, our Q3 2023 is going to be this because we're going to launch a new product at this time and we're going to have that much of sales. Nobody knows that's going to happen, but everything's based off of that, and people buy into that hot air, So yeah.
Wow.
I don't know. Does that answer the question? Okay, next.
It sounds like it's due for a pop. I mean, it just sounds like there's a lot of bull.
Yeah, for sure. No bubble has remained a bubble ever. So it's and when these bubbles pop, they pop pretty abruptly, and it's painful. So a lot of these intelligent macro guys have been saying, oh, get all into their advice is get into cash or get into bonds. I don't do the bonds, but yeah, I feel like getting into cash, like just being in the US dollar right now, is a good move if anybody has been able to do that. My portfolio took a pretty brutal hit with the whole crypto crash. But that's because I purposely didn't want to be in stable coins or dollars, because I was really scared about the stable coins blowing up. But anyway, let's just continue so I can just run through this. And if you have any questions, ask, just feel free to just, jump in and ask. So coming back to the bonds, now, we'll go to the real estate as well, but I guess it's organized a bit. Like I should have probably put real estate before the bonds, but fine. Let's just talk about the bonds. So bonds is like the new thing that's overvalued in this cycle. Earlier we had stock valuations that were really high, like the .com. Any company that was that had a .com in it was really highly valued on the stock exchange, and everything crashed. That happened around 2002. Then the real estate market was overvalued, and they were giving out mortgages like hotcakes with like a 5% down payment and stuff like that to probably to accounts and people that weren't able to sustain those mortgages when the economy went down and people lost jobs and stuff like that. The whole housing market collapsed. But now we're at the stage where probably the bonds will collapse, which is why I don't understand why some of these macro guys are saying you need to be in long-term treasury bonds. But anyway, so let's talk about what a bond is. A bond is basically an instrument that either a government or a company issues. It's basically a loan, but it's called a bond. So a company that wants to raise cash, but it doesn't want to give out its equity to outsiders, they say, I'm going to raise debt. Debt holders always come at the top. So they have the first right to a company's resources in the case of bankruptcy or insolvency. So basically they have the first right to the company's cash and liquidations when they happen. So they come like highest in the priority chain. And there's different levels of debt. So, but let's not go into that. We're just for our understanding here, we're gonna let's just say the government wants to raise debt to build roads and hospitals and airports and stuff like that. So they need money. So they say, okay, I'm going to issue a 10-year treasury bond. So that means you give me $1,000 today, and I will pay you an interest rate on that. And after 10 years, you get the face value, which is the 1,000. But you've got this interest every 6 months that I'm paying you. So let's say it's a 6% interest that they pay you. So every 6 months, you get a 3% on the 1,000. So you would get like $30, right? And then you get 60 per year or 6. Yeah. Yeah. So, and then at the end of 10 years, you get the face value. So you every year you're getting $60, $60 for 10 years. And at the end of the 10 years, you get the 1,000 that you lent me 10 years ago. So people are like, okay, this is pretty risky lending. So here, take my money. And, they sleep well at night knowing that it's a pretty solvent government. The US long-term bonds are known as risk-free investments. So people lend money to that. But now, the last few years, we've had a situation where these interest rates that these governments have been paying have dropped very close to zero. So we're seeing long-term bonds paying something like 2%, 2.5%.
Now, can I ask you a quick question?
Go ahead. Yeah, go ahead.
Does the inverted yield curve mean that something is flipped where now short-term bonds are offering better interest rates than long-term because people have less faith in the economy? Is that what it means?
Yes, that's exactly what it means.
All right.
So the inverted yield curve usually compares the 10-year versus the 2-year. And you see this, right? You have treasury bonds that are every single duration that you can think of: 1 month, 3 months, 6 months, 1 year, 2 year, 3 year, 5 year, 7 year. So you've got longer term. That's anything above 10 is long term, 10, 20. I'm pretty sure there's a 15 as well. Anyway, and then all of this is mainly like short term. This is midterm sort of. So what we're saying is that the 2 year, because the markets are so unstable right now, every time in the past we've had like a major recession, the 2 year flipped the 10 year. So what that means is you're getting a better, or investors are demanding a higher return in the short term, like around this time frame in this duration, than even the longer duration. So when the 2 year flips the 10 year, which means so this is the line, and this was, I haven't updated it, but this was as of April, early April-ish. And last I checked, the 10 is still slightly above the 2. But what this means is investors to lend money to the government are saying, hey, the markets are so freaking unstable right now that I need a higher return than even the 10-year for the 2-year. So all of the new bonds that are coming out, like now, current yields are like what's currently being offered, are like kind of like this. So usually a yield curve kind of goes like that, like goes upwards like that. But when you see an inversion, you're seeing, and I'm exaggerating with my mouse pointer, but you're seeing this sort of, movement. So obviously it's not this, but you have seen that. Like, see, this is the zero line. And in the past, every time, so this yellow shaded area is recessionary periods. And every time you have these recessions, you've seen that this is the 10 minus 2. So the 10 minus 2 should be a positive number, which means that in normal market circumstances, a longer term bond requires and pays a higher yield than a shorter term, like a 2-year. So 10 minus 2 low. So let's say a 10-year yield is 6%, a 2-year yield is 2%. So the 10 minus 2 would be a 4. So you would actually want to see those numbers over here. But when they drop below 0, that means the 2-year is paying a higher yield than a 10-year. And that sort of situation is always followed by a recession. So I hope that's kind of clear. And we're kind of in that sort of territory right now. Is that clear? That's kind of a complicated slide, so, but yeah. So another thing that's happened from this COVID thing is the cost of living crisis. One of the repercussions. Obviously, all of these that I'm talking about is due to the money printing, direct effects of the money printing. So the CPI, and I talked about this at the conference, basically is kind of like a pointless indicator. It doesn't mean much. And the reason it doesn't mean much is because anytime you have an increase, so let's say I have a 0 point here and I want to measure something that's gone up from 0, I need this 0 number to be stable, right? So the CPI basically measures the increase in cost of living, consumer price index, but the CPI is an indicator that is measured in US dollars. Now, the US dollars, like all of us know, is not a stable number. Like it's not like it doesn't stay on the 0 line. It keeps going up. So when you have your base value that keeps going up, you don't have an accurate measure of prices that go up against that. Does that make sense? I hope that makes sense. So that is one reason why the CPI is a pretty bullshit type indicator. It doesn't make much sense, but I mean, they like to talk about it. And there's a lot of noise on Twitter and in the markets every time there's a CPI release. Oh, they're releasing the CPI numbers. It's 8.7%. Oh, well, it doesn't mean much, to be honest. You cannot measure something against something that's always moving. And the dollar is like literally doubled. So in the sense, if there were $100 in the system in 2020, now there's 200. And we're saying it took 100 years to get to those $100, right? And they doubled in 2 years. So there's definitely no stable sort of base value where you can measure an increase from. So that's one reason. And the second reason the CPI is again like a complete bullshit indicator is because the basket of goods that makes up the consumer price index should include things like food, housing, transport, energy, all of that stuff, but it doesn't. So in like the 80s or something, they took out a lot of these food, energy, and housing related indicators, and it's just full of things that actually become cheaper over time. So things like computers and user electronics and things like that. So obviously your USB drive, like your memory stick, gets cheaper. So for example, you used to buy like 10 years ago a 256 megabyte USB stick. Well, now you buy that for nothing, or you buy the same, you pay the same for a terabyte or whatever it is. So what I'm saying is they've included goods that get cheaper But actual goods that everybody uses every day, like food, housing, and energy related, they have mostly been taken out. So yeah, that's two pretty important reasons why this is a pretty bullshit number that really makes no sense. And the actual numbers are much, 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 much higher than this 8% bullshit number that they tell us. So we're actually looking at easily, in my personal opinion, because nobody on this planet knows the real number, we're easily looking at a 25% or something like that for most goods, especially food, which everybody consumes every day, housing as well. So yeah.
Lying with statistics.
Yes. How to lie with statistics.
I have a question.
Master that. Yes. Go ahead.
When I look at this chart, I don't see any reason not to short every single real estate investment trust on planet Earth. What is your take on this?
Yeah, real estate is overvalued. So again, my next point that I was about to make is, well, if you cannot trust this number, the CPI number, what number do you trust, right? To tell us kind of where we are going with this cost of living crisis, and where our price is headed, and what are things actually costing us. So we're going to look at this chart, the average US house sale price chart, and we're looking at close to 500K for an average home, price in recent months. And we're looking at a median income. Now there's a median personal income and a median household income. And we're looking at, look at this, like under 30K and under, this is under 70K, if I'm not mistaken. Yeah, so yeah, I mean, so just look at this. Median personal savings rate in the US as of right now from the Fed's website was 6.4%. So if you're saving 6.4% of your paycheck on an annual basis, which average households would do, and they're making under 70K, which an average household does, and the average household has to pay 500K almost for the average home price, then you're fucked, because it would take you about 96 years to pay off a home. So yeah, I mean, shorting real estate is definitely a good idea. Shorting literally about everything, because everything's so overvalued. So is equity. So is bonds. So what we didn't talk about on the previous slide, when we discussed the yield curve, we're looking at bonds at historic, like, highest prices, because and this is a bit technical, when a government issues issues a bond, and they say, look, I'm gonna this bond costs $1,000 and you're gonna get a 6% interest rate on this bond at the over 10 years time, and then on the 10th year you're gonna get your $1,000 back. Fine, but over the last few years, we've had bond prices drop so much that, the bond yields drop so much that these older bonds that were issued like 20 years ago that had 6%, 7%, 8% interest rates, annual rates, they became so freaking expensive because the newer bonds that are coming out are yielding like 2% for 30 years or 15 years or 10 years. So imagine a bond the largest financial markets in the world are bond markets, not any equity market. Like, the bond markets are so much bigger than all the equity markets, right? So just think of the magnitude of the bonds that exist, and all kinds of durations meaning like how long they're going to be repaid, how long it's going to take for principal to be repaid. So what we're seeing is, like, real estate is skyrocketing high, equity is, you saw the multiples table, skyrocketing high, and bonds have become so expensive over the last few years because of all these near zero yields that were being offered over the last 5-7 years, that all of the older bonds became really expensive. Is that making sense? Like, bonds that were issued way back in time with higher interest rates, they become super expensive, which is why when yields go down, bond prices go up. Inverse relationship. I hope
Yeah, that
that's
makes sense because if 2-year flips 10-year, you got sovereign defaults if it stays above it long enough.
Yeah, so sovereign default is when rates start going back up, which is what's happening now. Now they're saying, oh, now we're going to try and control inflation by increasing rates artificially. What they don't realize is this beautiful chart right here, looking at literally, pretty much all the countries in the world that are so over leveraged. Now look at
Wow.
this. Yeah, look at sovereign debt to GDP. So earlier we looked at a chart that had equity valuations versus GDP. Now we're looking at the debt side of it. So we're looking at sovereign debt. So sovereign meaning country's debt. So what a country has taken on its balance sheet, not its companies, but that country itself. And look at here. So the US is here at 133, which looks pretty decent compared to the neighborhood, because you're looking at countries that are 200 and 10, 207, Japan, of course, 250 plus. So you're looking at countries that are so leveraged that their future generations, before they're even born, they're entering the world with their country's debt sitting on their shoulders. Like they're going to be repaying future debt for the next, I don't know, 50 years until they repay all of this, assuming they don't create any new debt now, which is not happening. They're creating even more debt. So as they print money, they have to keep issuing bonds, and some idiot's going to buy those bonds because a lot of the bond buyers haven't realized, or maybe we're the idiots and we haven't realized that bonds will have, like, some investors honestly think that bonds are where everybody should be right now, long-term bonds, because they're going to be safe. But I feel like we're going to start seeing this blow up. Like we're at the risk where entire countries now start going insolvent. And the only way to stop that is by more money printing. So either you stop the currencies from exploding or you stop the countries from exploding. I don't know if that makes sense. Does that make sense?
Not really, because those seem to be like direct relationships.
So imagine they keep printing dollars to repay all of this debt, right? Because over the last 2 years they've printed so much money, and when they print the money, they have to issue bonds against it, a lot of it.
I see.
So and the bonds carry interest, So I don't have that chart here, but I should probably add it to this. There is a very interesting chart that shows that the GDP is not even sufficient to pay off just the interest cost. Like, let's not even think about the principal that's due on a lot of these bonds. So the principal is the face value, and the interest is what you pay, every year. So if I'm the US and I have a 6-year outstanding, a 6% outstanding 30-year treasury bond. So after 30, so somebody gave me $1,000 today, and they want the $1,000 back in 30 years. I'm obliged to pay them 6% every year for that, for that favor. So they don't even have enough to pay the interest. So never mind the principal, that 1,000 that's due at the end of 30 years. Sorry, go ahead. Questions? Any questions?
Yeah, no. So does the Fed goes on the open market, right? And if they want to increase the money supply, one of the ways they do that is, do they buy bonds, right? So they buy bonds and they're shooting out cash, right, into the economy. But now they've stopped doing that. Is that one of the ways they've tried to stop inflation?
So if they don't have buyers for those bonds internationally, so for example, when when these GCC countries discovered the crude oil in the 70s, they struck up these deals, and it was right after Nixon took the dollar off the gold standard in 71. And in 74, they came into this petrodollar arrangement, and they told these countries that, hey, like they came to Saudi basically, and they said, we're going to protect you from Israel. Our military is going to protect you guys from Israel. And in exchange, you got to price all that crude oil that you found in US dollars. And any surplus that you have, all your profits, basically, you have to invest a certain portion into our bonds, right? So that was the agreement. And so, a lot of these countries are sort of obliged to put a certain amount of treasuries on their balance sheets uh, by accord or by agreement. But I think those agreements are like watered down now. They're basically falling out. So I don't think they're doing it as aggressively as they used to, like over the 80s and the 90s. But you think about a lot of the bonds that are still outstanding from that time frame, the higher interest bonds, because in that period you had very high interest rates, like close to two digit, like 10%. So when you have a 30-year bond that was issued in 1985, or let's say 1990, yeah, well, that's paid off. But yeah, I mean, so okay, maybe in the late 90s or something. But you're saying like a lot of the bonds that were issued at really, really high interest rates back in the day, there are still some of them are not due yet, or they're not like they're still paying off interest on those. So yeah, it's going to be easier to pay off the last few years bonds that they've issued, where they've said where rates have been closer to zero, or like 2% for a 30-year, or 3% or something like that. But or